In the world of financial investing, there's one work that stands like a shining lighthouse. It has weathered the years and continues to radiate a captivating light. This is Reminiscences of a Stock Operator. The book is based on the early 20th century Wall Street legend, Jesse Livermore. It's like a Wall Street roller coaster saga. He entered the market at 14 with $5 in his pocket. By 15, he made his first $1,000 by tracking price swings. At 21, he lost everything in the legitimate stock market, then made a comeback using his wits in bucket shops. By 29, he was a millionaire, but lost it all in cotton futures by trusting others. At 30, he made $3 million back with a precise short. At 52, he made a staggering $100 million, equivalent to billions today. He went bankrupt 4 times and rose 4 times, fighting in the stock market like a lone swordsman. Even Warren Buffett admits he's never seen anyone who understood the market better. These wild ups and downs hide the rawest game of human nature. Reading his story is like taking a walk through the stock market's purgatory in advance. All right, let's open the book and get to the point. Here's a tough question. When you trade stocks, are you staring at the K-line charts or the company's financial reports? Livermore discovered a secret at age 14 while working as an errand boy in a brokerage firm. The numbers on the quote board weren't just prices, they were an electrocardiogram of human nature. He watched stock price fluctuations daily, recording patterns like a detective. One stock would always consolidate for 3 days before rising. Another would have 3 fake rallies before falling. 6 months later, when he first turned $5 into $3.12 in profit, it wasn't luck. He discovered that stock prices have habits, just like people. But most people trade stocks like they're betting on red or black in a casino. There's a particularly ironic detail in the book. When Livermore was in the bucket shops, those well-dressed clients always loved to fish for insider tips. Some even used astrology to pick stocks. They weren't investing, they were pretending to trade, using complex indicators to hide the fact that they were just guessing. This reminds me of old Wang at my neighborhood gate. Every day he looks at K-lines on his phone, muttering about MACD Golden Cross, volume expanding. Ask him what the company he bought actually does, and he stammers, unable to say. Isn't this exactly what Livermore called the child's game of guessing up or down? Livermore later warned that price is the most superficial appearance. Betting on up or down is a child's game. He came to New York at 21 with $10,000 earned in bucket shops, but lost it all with a legitimate broker. Because in bucket shops, you just guess the direction. But behind Wall Street, stocks are living businesses, unpredictable capital, and rapidly shifting trends. You might ask yourself, are you researching if a stock will rise or why it might rise? The former is gambling, the latter is the first lesson in speculation. Livermore went bankrupt 4 times in his life. At his worst, he had to borrow money for meals. But he said bankruptcy is the best teacher, especially before his 3rd bankruptcy. He made $3 million during the 1907 market crash, but then lost it all in cotton futures because he couldn't bear to cut his losses. He later wrote that mistakes are like a virus. If not cut out promptly, they can be fatal. At the time, he clearly saw cotton prices break through a support level, but comforted himself that it was just a pullback. He watched the loss grow from $250,000 to $1 million. Does this scene feel familiar? A stock you bought drops 5%. You tell yourself you'll sell on the rebound. It drops 10%. You decide to get out at break even. It drops 30%. You just play dead. And just like that, a small loss becomes a deep trap. Livermore laid bare the truth. Stopping a loss isn't admitting defeat, it's preserving your right to keep playing. His stop-loss principle was brutally simple. If it doesn't match your expectation, close the position immediately. With Union Pacific stock, he shorted it but saw an abnormal price rebound. He made no excuses. He closed all his positions within 3 minutes. It was later proven to be a short squeeze trap. Now look at us. How many people holding on with a wait a bit longer mindset let a small mistake turn into a disaster? There's a statistic in the book. Livermore calculated that only 45% of his trades were profitable. But by strictly limiting losses to no more than 5% of his capital per trade, and with average profits reaching 20%, this is the difference between a pro and a retail investor. It's not a high win rate, but knowing how to let profits run and cut losses short. I have insider info, such and such stock is going to skyrocket next week. Doesn't that phrase always seem to haunt your ears like a curse? Livermore hated insider information more than anything in his life. In Palm Beach, the president of Borneo 10 secretly told him, "I'm only telling you, this stock will hit $200. His wife bought 100 shares behind his back and lost badly. Why is insider information unreliable? Livermore dissected the trick. The insider will only tell you when to buy, never when to sell. Just like that president, he needed retail investors to take the shares off his hands. So, of course, he talked it up. There's an even harsher case in the book. An insider for a certain stock was feeding bullish news to the media while quietly selling his own holdings. Once retail investors took the bait, the stock price was cut in half. You must know people like this. They hear a fund manager is heavily invested and jump on the bandwagon. They see the chairman increasing his holdings and rush in. But Livermore warned, if even the nanny knows a stock is going to rise, that's when you should sell. How did he judge? He looked at the tape. If a stock truly has value, insiders will buy quietly, not shout it from the rooftops. I recall a friend recently buying a state-owned enterprise reform concept stock. He bought it based on an insider tip and was stuck with it for half a year. That's not an inside tip, it's clearly a harvest signal. Livermore put it clearly, the most reliable inside information is the market's own trend. Before the 1907 U.S. stock market crash, everyone thought the bull market would last forever. But Livermore, even before the San Francisco earthquake news broke, shorted 3,000 shares of Union Pacific based on his market intuition. When the disaster news was announced and the stock plunged, he made $250,000. Behind this lies a counterintuitive truth. Money made in a bull market tests your luck. Money preserved in a bear market tests your wisdom. Livermore found that most people in a bull market get so high they forget who they are. They mistake luck for skill and use leverage to amplify risk. Until the bear market comes and they give it all back. Principal and interest. There's a detail in the book that's a real wake-up call. At the peak of the bull market, Livermore saw retail investors in the brokerage house start discussing, should we take out loans to buy stocks? Some even mortgaged their houses. He liquidated his positions immediately. Because when the most conservative people start going crazy, it's time to exit. Look at now. Don't you also have friends telling you that dollar cost averaging into funds is a sure win? Or that you can just lie down and win in the new energy sector? Livermore's method for judging the overall trend was actually very simple. See what the majority is doing, then do the opposite. Before the 1929 Great Depression, he saw barbers talking about stocks. He decisively went short and became one of the few who made money in that crisis. This is what he meant by loneliness is the speculator's destiny. The major trend is your only reliable ally. You might ask yourself, are the people around you now discussing how to make money or complaining about losses? This might be more accurate than any indicator. This stock has fallen 50%. Time to buy the dip, right? Livermore would sneer at that. His most proud trade in life was making $3 million on Bethlehem Steel in 1915. He didn't buy at the lowest price. He waited until the stock broke above $100 before entering, then rode it all the way to $150. He said, nobody can catch the lowest penny, just like nobody can sell at the highest penny. This is completely counter to our intuition. Auntie Zhang in the neighborhood always says buying on the dip, not the rise, is smart money. But Livermore proved with real money that the trend is more important than the price level. It's like climbing a mountain. You wouldn't see rocks rolling down halfway up and still firmly believe the peak is ahead. His pyramiding method is especially worth learning. Buy 1,000 shares to test the waters. If it rises, buy another 2,000. If it continues to rise, then go in heavy. If the first batch loses money, stop the loss immediately. It's like testing the water temperature, not jumping straight into icy water. Now look at us. Don't we always like to go all in, aiming for either a huge win or a huge loss? Livermore, at 20, lost every penny of the $10,000 he made in bucket shops in the New York stock market. He later reflected that wrong profits are more dangerous than losses, because money made by luck makes you mistakenly think you've grasped the truth, until the market delivers a fatal blow. This reminds me of the young people buying funds a couple of years ago. They doubled their money riding the new energy trend and thought they were investment geniuses. They used leverage to chase hot sectors, and last year's drop made them question their life choices. Livermore was right. The stock market is the fairest place. It rewards your correctness with profits and punishes your mistakes with losses. But first, you have to know what's right and what's wrong. His harshest lesson was listening to Percy Thomas's advice on cotton futures. That man was the cotton king of the time, extremely eloquent. He persuaded Livermore to change his own judgment, resulting in a $1 million loss. This is what he warned. The smartest Pete Zveronifan is believing someone smarter than themselves. Don't we also have such gurus around us? They might be finance bloggers, fund managers, or even relatives and friends. Livermore's advice is, you can listen to their analysis, but always verify with your own eyes. Just like when he studied cotton, he didn't look at what Thomas said, but at the buying and selling pressure on the tape. Money doesn't lie. Reading this, you might ask, how do I turn these principles into action? Livermore summed up 7 rules from 40 years of blood and tears. Each is worth $1 million. Rule 1. Learn how to lose money first, then learn how to make it. He said you have to make every single mistake. Each lesson requires real money. What beginners should do most is test with small capital. Figure out exactly how much money you'll lose, falling into traps like chasing rallies, not stopping losses, and listening to tips. Rule 2. Don't be a stock zombie, be a market detective. Don't just study indicators all day. Ask more. Why is this stock rising? Is it good performance, or is it being pumped by capital? Livermore looked at the quote board daily, not at the numbers, but guessing what the money behind them was thinking. Rule 3. Stopping losses should be like ripping off a Band-Aid. Fast, accurate, and ruthless. The standard is, loss on a single stock must never exceed 5% of your capital. No matter how bullish you are, if it breaks below this line, close the position immediately. Remember, the market never lacks opportunities. What's lacking is capital. Rule 4. Let your profits roll like a snowball. When you catch a trend, don't be in a hurry to take profits. Livermore held Bethlehem steel from $100 to $150. He did it by not letting go until the trend was over. Patience in profits is as important as decisiveness in losses. Rule 5. Don't get into a fight with the market. His lesson from 3 bankruptcies tells you, if the market proves you wrong, even if your mouth is hard, your actions must be soft. Don't think, I'll get out when I break even. Wrong is wrong. Admitting mistakes promptly saves your skin. Rule 6. Stay away from favor stocks and insider tips. Livermore said the market doesn't reward loyalty. Deadly personal ties will make you lose everything. Stocks recommended by friends or stocks of companies where relatives work are often the most dangerous. Rule 7. Remember, your biggest enemy is yourself. Greed will make you chase highs. Fear will make you sell at a loss. Wishful thinking will make you hold on. Livermore lamented in his later years, "It took me 20 years to realize that beating the market is less important than beating myself." Livermore died by suicide at 63. His final words were, "My life was a failure." This legend, who made $100 million, ultimately lost to his obsession with proving himself once more. This might be the stock market's deepest metaphor. True victory isn't how much you make, but knowing when to stop. Just as he himself said, nobody can catch every fluctuation. You just need to be the one laughing last. If you ask me what the biggest takeaway from reading Reminiscences of a Stock Operator is, it's not how to pick stocks, not how to read the tape. It's understanding that the stock market is a mirror reflecting your ability to control desire, fear, and wishful thinking. Livermore's $100 million was merely a byproduct of him overcoming human nature. Finally, here's a line I look at whenever I feel like chasing a hot trend. The people who survive on Wall Street aren't the smartest, nor the luckiest, but the ones who can control themselves best. Are you ready to be that person who can control yourself?